If you've ever written a check to a charity and claimed it on your taxes, you are going to want to hear this. 2026 is about to completely change the math for you, and honestly, most Americans have absolutely no idea it's coming. Welcome to today's Explainer. We're talking about the July 2025 One Big Beautiful Bill Act. Sure, it made all those headlines for making old 2017 tax provisions permanent, but tucked quietly inside that massive piece of legislation is a brand new charitable giving deduction floor that is going to catch a lot of donors off guard. Okay, let's dive into this. Is 2026 changing your charity math? For most Americans, the answer is a resounding yes. This is exactly the kind of quiet, stealthy policy change that doesn't make the evening news, but it absolutely hits your wallet when April rolls around. The tax code is literally shifting beneath our feet right now. If you just go about your normal charitable giving without adjusting your strategy, you're probably going to find yourself losing out on deductions you've just always relied on.
So, here's the number you really need to remember, and here's what it means in plain English. 0.5%. Starting in 2026, before any of your charitable donations can actually be deducted, you first have to clear a threshold equal to 0.5% of your adjusted gross income, or your AGI. Think of it kind of like a deductible on your car insurance. You know how you have to pay out of pocket up to a certain point before your insurance actually kicks in and helps you out? It's the same exact concept. You get zero tax benefit for your donations until your total giving crosses that 0.5% line.
So, the crucial point is understanding how this plays out in actual dollars and cents. Let's say your adjusted gross income is exactly $100,000. Under the old rules, if you donated $2,000 to charity and you itemized, that whole $2,000 was deductible. Simple, clean, totally rewarding. But under the new rules, you have to subtract your 0.5% floor first. 0.5% of $100,000 is $500. So you subtract that $500 from your $2,000 donation, and now only $1,500 of your donation actually counts as a deduction. That $500, it just disappears from your tax benefit. Poof, gone. And this brilliantly illustrates the real-world impact of how that $500 just vanishes. Your out-of-pocket donation is the exact same. You're still generously giving $2,000. But in 2026, your deduction drops. Now, I know $500 might not seem like a totally catastrophic loss for the average donor, but think about this. If you give consistently, or if you're a high-income earner writing 5- and 6-figure checks to charity every single year, this floor scales up incredibly fast. That missing gap becomes a massive hurdle and can meaningfully shrink your tax savings if you aren't paying attention.
So who actually needs to worry about this? Let me start with a massive sigh of relief for a lot of you. This only applies if you itemize deductions. If you take the standard deduction, which honestly, most Americans do, this floor doesn't touch you at all. You are perfectly safe. But if you are an itemizer, you're the one taking the hit. This disproportionately affects higher income households, folks who are frequent steady donors, and people who bunch large one-time gifts. If you fall into any of those buckets, your math is changing big time. And look, it's not just taxpayers sweating this out. Nonprofits across the country are watching this extremely closely. Financial advisors fully expect this new floor to subtly reduce the incentive for making smaller, itemized gifts. I mean, if a smaller gift doesn't clear that floor, you get zero tax benefit, right? So nonprofits are anticipating a behavioral shift. They're expecting donors to hold off on those smaller, regular contributions and instead pivot toward making much larger but far less frequent donations, just to easily clear the floor and make the whole process worth it. Let's move to and see how this builds into an actual proactive strategy. What should you actually do with this information? Well, the primary tactic accountants are recommending right now is called bunching. Bunching is exactly what it sounds like, giving 2 or 3 years' worth of charitable gifts in a single tax year.
Since that floor hits you every single year you itemize, a bigger one-time gift dilutes the fixed dollar loss from the new floor. You take the hit once, maximize your deduction, and then just take the standard deduction in your off years. Now, if you are charitably inclined and happen to be sitting on some appreciated stock, a donor-advised fund, or DAF, is worth a really serious look. This is a brilliant wealth-building secret. Instead of taking a hit from that deduction floor every single year with regular donations, you can use a DAF to front-load multiple years of giving all at once. You get the deduction calculation done, and you take the hit from the floor exactly one time. But the best part? You don't have to give all that money away immediately. You can still distribute the money out of the fund to your favorite charities gradually over time.
All right, let's get down to the tactical takeaways. Step 1. If you are a regular itemizer, you need to talk to your accountant right now. Seriously, do not wait until March when they are completely slammed. Step 2. Run the math on bunching or opening a donor-advised fund. And step 3. This is absolutely crucial. If you are someone who gives smaller, steady amounts throughout the year, you have to flag this specifically to your tax preparer. This specific 0.5% floor is incredibly easy to miss if you're just plugging numbers into standard tax software without a real review.
Now, what's really interesting about this slide is the absolute bottom line here. The tax code is quietly asking you to be more intentional with every charitable dollar. This is not a reason to stop giving to the causes you care about. Not at all. But it is a very real call to get strategic about how and when you give. The rules of the game have changed for 2026. So I'll leave you with this. Is your current giving strategy just running on autopilot? And if so, how much is that complacency going to cost you when tax season rolls around? Get ahead of it now. Thanks for joining me on this explainer, and definitely share this with anyone whose charity math is about to change.